This is Ron DeLegge with ETF Guide. Great to have you with us. I've got a couple of slides that I want to share with you along with a special announcement, so stay tuned for that. We're going to blaze through what's going on with financial markets as we head into the long weekend, Memorial Day. And here in the U.S., here's what's going on. The great Gerald Loeb once said that it's public psychology that is the number one factor that shapes market prices. So, what is public psychology saying about financial markets today? Well, if you take a look at the Fear and Greed Index, right now we're in greedy territory, people. And if you compare this current reading to just a month ago, we were neutral. Last year, we were extremely fearful. So we're exact opposite levels today. And so that's sort of a read on public sentiment or market sentiment. What about the actual bottom line numbers? Let's take a look at this from a industry sector performance perspective. I like to take a look at the 11 sectors of the S&P 500, and we've got those offensive, high-octane industry groups leading in terms of year-to-date performance. When I say year-to-date, that's since the start of the year, January 1st. This is through the market close of May 26th. XLK, XLC, XLY. These are the top three industry sectors within the S&P 500. XLK gaining over 32%. And the top three holdings, by the way, inside XLK are Microsoft, Apple, and NVIDIA. All three of those stocks performing very strongly. That certainly has driven up XLK as well as the entire S&P 500 as a group. If we look at this from another angle, let's just look at this from how much of the S&P 500 index itself do these three top performing sectors represent? Almost 47%, or almost half of the S&P 500's overall makeup can be explained in these three sectors. So that explains why the S&P 500, and we're going to take a look at the performance of that index in a second, is up now double digits, just up 10%. So in terms of overall industry sector performance, 7 sectors are down, 4 sectors up. Some of you may be saying, well, why is S&P 500 up if more sectors are down than up? Well, there we go back to this explanation of those top 3 industry groups accounting for a big portion of the overall S&P 500's exposure, equity exposure, and that has been driving S&P 500, the overall index, up. So even though we've got a smaller number of industry groups ahead, the size or market cap of the stocks in those industry groups is big, very big. Like I said, those NVIDIAs, Microsofts, Apples driving prices higher. Now, in terms of overall stock market benchmarks here in the U.S., the top 3, Nasdaq 100, S&P 500, Dow 30, it's the QQQs, which are dominating, ahead by just over 31% since the start of the year. And really, this is a very tech-heavy sector or benchmark, which explains why it's done so well. And of course, the tech sector, as we described earlier, being a top-performing sector, and that certainly has helped the Qs. Now, here's a tweet that was sent out by our good friend and colleague, Eric Balchunas, who is a lead ETF analyst over there at Bloomberg. An amazing stat that the triple Qs have beaten every single growth manager over the past 10 and 15 years. The index is a real powerhouse, full of the best U.S. innovation, and hard to argue with that. Although I will say the triple Qs in all their glory are still a flawed index, because remember, it's just taking Nasdaq-listed companies, the top 100, and it excludes those innovative companies listed on non-Nasdaq exchanges. So you're missing great companies that are listed on, for example, the NYSE. Plenty of innovative companies there. But again, even for those flaws, triple Qs still has been a powerhouse in terms of performance, outperforming or beating every single growth manager over the past 10 and 15 years. That's pretty dominant. And it speaks to the power of index investing. This is why I tell our audience that indexes and indexing should be the foundation or the core of your investment portfolio. That's where you start. You begin with low-cost index ETFs. That's the foundation. And then if you want to add other things, you want to embellish your portfolio with active funds, with funds that use leverage, with specialty asset classes like cryptocurrencies, volatility, hedge funds, venture capital, whatever. That all goes in your non-core portfolio, but your core or foundation should be the index ETFs that are broad in scope and that touch the major asset classes. I think of the 5 biggies: stocks, bonds, commodities, real estate, and of course, cash. And so that's where you begin. Now, in terms of the top leveraged ETFs, these are the 3X. That means they aim for 300% daily leverage. Soxel, which tracks semiconductors with 3X daily leverage. Man, look at the past week or so of Soxel. It has just spiked. I mean, this thing was up about 70%. Now it's up over 136%. Bada bing, bada boom. Pretty big run there for Soxel over the past week or so. Tekel also showing some strong performance, up over 111%. Remember, Soxel's got NVIDIA in it, so that stock leading the way, and of course, all of those other companies within that group following NVIDIA's lead. SPXL, which aims for triple daily leverage to S&P 500, also performing well, ahead by almost 25%. So, key takeaways. Sentiment towards stocks is still bullish. In other words, the public psychology, and as we described earlier, that is the one factor that drives market prices. You can agree or disagree all day long. We can argue about it. It's not dividend yields. It's not the Fed. It's public psychology that determines market prices. And right now, markets are happy. The greed fear index is modestly greedy, not yet at extreme levels. We're getting there. And we've got major stock benchmarks still trading near year-to-date highs. I want to remind all of our audience members that now is the time to have and install a margin of safety within your portfolio. If it's got an IRA, 401k, other investments, you should absolutely have a cushion which gives you protection, liquidity, and zero volatility that will help you during not just good times, but also bad times, and ride out the volatility. And especially those of us that are nearing retirement or at retirement, we should absolutely have a margin of safety that is larger in size compared to those that are still in the accumulation phase of their investment plan. And speaking of retirement, I want to invite everybody watching to my next live event, which is going to be on June 1st. We're going to get started at 8 a.m. Pacific, 11 a.m. Eastern Standard. And I've got a retirement planning webinar. This is our second this year. We began in Q1, and it was very successful. We had a great turnout. Registration is free. There's no cost to attend, but seating is limited. Also, all attendees get my ebook titled 60 Smart Ways to Retire Better. And we're going to cover everything that you need to know about retirement right now and what's different today versus the past. A lot has changed. The previous generation, their retirement was different than those of us that are retiring today and those of us that will retire in the future. And there are a lot of reasons for that. Obviously, the big one is taxes. Taxes in this country are going to skyrocket. And so if you're not planning or prepared for that, you have got some serious things to think about. And we're going to talk about that with our retirement planning webinar. We'll talk about powerful strategies for maximizing your retirement income cash flow. That's pretty important, right? Making sure you don't outlive your money. And in retirement, remember, your standard of living is determined not by your account balance, but by your income. And so that's why we're going to focus on that one. How to get your RMDs and Social Security tax-free. Oh, that's a good one. And then we'll talk about Roth IRA versus traditional IRA. Also discuss Roth conversions. And then we'll have some Q&A with you, the audience, time permitting. I will also have a special guest joining me, so don't miss it. Again, June 1st, and this is going to be a 4-hour event. So bring your coffee. We're going to have a little bit of a break, about a 10-minute break at the midway point, but everything you need to know about retirement and planning, distribution pitfalls, how to avoid that. And so again, don't miss it. I've got the registration link below, and we'll see you on June 1st. Enjoy your Memorial Day holiday, all of you, and we'll see you on the next episode.